All right, Steve, thank you very much. Stick around as we get back to our panel for some reaction there. I think Steve has characterized it well. It feels to me like the language indicates that the Fed is putting the ball on the tee and is going to whack it real soon.
I think that's totally fair. And that's exactly, they have to talk about cutting before they actually do the cut. So this is the meeting where they're setting that up. And that's exactly what the statement has detailed for us. They're telling us the risks have changed. Now it's about both sides of the mandate. They don't want to see the unemployment side of their mandate really start to suffer. And given that the unemployment rate has legitimately started to rise, arguably our opinion is it's more supply-driven than demand-driven, but it has started to rise. We're seeing the softening in the labor market, and the Fed has to be cognizant of that. They're trying to land the plane, and in order to do so, it makes sense to be cutting at this point, with inflation now coming back down very much below their 2.5% target on, or at least the 2.5 level that they've outlined on most measures when you look back on 1 and 12 months.
David, go ahead. What do you make of the markets reaction? It's largely treading water, or not treading water, but unchanged from going into the decision.
Well, I think it's probably more or less as expected. I do think there are quite a few comments, changes in the statement, all of which are in the dovish direction. So it's more than one or two gentle chimes indicating that a rate cut is coming. They're banging away in the gong quite a lot to let people know this rate cut is coming here. I am a little concerned. I don't want them to talk about this in terms of a weakening economy. I think they're on the right track if they say, look, we're going to normalize rates because inflation is normalizing. If they can stick on that theme, I think it'll be much less alarming than if they say, well, the unemployment rate's going up a bit and we're more worried about the other side of the mandate. Because as soon as the Federal Reserve expresses real worry about the state of the economy, that doesn't speed the economy up. That slows the economy down. So they need to be careful not to do that and just stick to the point that, look, inflation's coming down. That justifies us normalizing rates.
Jim, were there any surprises in what you hear in the language that Steve so ably summarized for us? And then I want to come back to your idea that a September rate cut is no better than a 50-50 chance. Do you still feel that way based on what the Fed has just said?
Yes, I do. So let me start there. Look, I mean, the two things I heard in the statement and what I'm queuing off of is moving into better balance and focusing on both sides of the mandate. So what that really means is that we're not so worried about inflation anymore. We think it's moving in the right direction. Right now, the key is employment. It's jobs growth. We're going to get more data on Friday. We're going to get another payroll number before they move again. So look, we have this thing that we call a fear framework, which is the Fed, employment, asset prices, and interest rates. And essentially what the interplay is between all of these is the employment situation is the absolute key. If employment slows, doesn't collapse, but just cools enough such that wage inflation is coming down, that's the key ingredient that gives the Fed confidence to start to cut interest rates. We got an ECI data print today. Everything seems to be moving in the right direction, but still, we have a few more data points ahead, so I wouldn't want to get too excited. Like, September to me is still 50-50. Even if they go, I still think it's a close call.